For more on the Wild Week, joining me to discuss this is Thomas Hayes, founder, chairman, managing member of the Great Hill Capital. Good to see you, Thomas.
Great to see you, Phil.
I don't know. I'm kind of like sad, mad, and kind of angry at the same time. Like I don't even know why. I think maybe it's from all of John's sort of reports on how bad the market is. And I think this weekend most investors are going to want to avoid looking at their portfolio. So what are we supposed to worry about next week?
Well, you had the biggest policy mistake by the Fed in 110 years of history this week. Basically, if you look back at last year, September 2021, when PCE inflation expectations were 4.2%, GDP estimates for 2022 were 3.8%, they thought it was a good idea to keep the Fed funds rate at 0.10% or 10 basis points. And now that GDP estimates have absolutely collapsed to 0.2% for 2022, they think it's a good idea to take the Fed funds rate up to 4.6%. So they're oversteering the car into a ditch. They understeered it last year. Now they're overshooting on the wrong side. And what you're seeing is credit markets seize up. So they don't know it yet, but they're going to have to walk this back sooner rather than later. You're seeing global sovereign yields in Europe. The Italian 10-year yield is at 9-year highs. The ECB is back in the market with their new quantitative easing facility. They're going to have to be buying those bonds. And it's largely due to just a continuation of mistakes. And this really reminds me of when Jay Powell came into office in December of 2018. If you remember that famous press conference, the market was acting weak because of the trade war. It was down 6%. And what did he decide to say at the press conference? We're going to keep quantitative tightening on autopilot. And he took a 6% correction into a 16.5% correction.
I mean, all right, Thomas, you're not helping us. Like, I'm trying to feel better about Monday. You're making me feel worse. So you're saying that Powell and all his buddies at these central banks are all bad drivers and we're stuck in the passenger seat. I just want to know, what are we supposed to do on Monday? Am I supposed to just sell everything and call it a year, or are we supposed to go out and buy stocks? It's sort of like we can't just do nothing, right? Or maybe we can.
Oh, so you want the good news too? Okay, I gave you the bad news, Phil. Now here comes the good news. The good news is managers are already positioned for the apocalypse. So they have more cash than they did at the pandemic lows, at the great financial crisis lows, in the tech wreck lows. So what that tells me is we're at extreme pessimism, and it often pays to be a buyer versus a seller. But when you're in these uncertain periods, you want to be buying the most high quality businesses that you possibly can. You don't want to take speculative stocks. You don't want to take big risks. You want to buy, the Disneys of the world, the Nikes of the world, the Metas of the world that are down 30, 40, 50%. But when you look 3 to 4 to 5 years out, they're going to be selling more of their product in the future than they are today.
What you're saying is don't buy the stuff that I already have, is what you're saying. Now, the other part of this whole thing is the interest rate hikes have a huge impact on home prices because people borrow a ton of money to buy homes. Am I selling a house, or should we be buying a house right now?
I think you should be waiting. I think we're going to get closer into the winter. Demand is going to ease. Housing prices are coming down. Owners equivalent rents will, by the way, work on a lagged basis, and that's what the Fed is really missing. The PPI numbers started to roll over. We've seen commodities roll over, and they're just missing the signals is really what it comes down to. So I would expect with this level of pessimism and what's happening in the credit market seizing up, they're going to have to walk it back like they do every time the credit markets seize up. And that could come much sooner than they even expected. So you don't want to get too pessimistic. You don't want to buy insurance after the house is already burned down. And when you look at the correction this year, the house is already burned down. You want to look among the rubble for some treasures and some jewels, but you really do have to start with the most high quality stocks until we get some stability under the market and some footing.
Goldman says 3,600 on the S&P. We're about 150, 200 points away from that, so we're fairly close. And Powell says there's more pain. So I guess what I'm trying to figure out is how much more pain is there? I mean, in a way you're saying there's a lot of pain, but we're near the end of the pain?
Well, here's the thing. We already had a recession. Technically, we had 2 quarters of negative GDP growth. The Atlanta GDP now is tracking 0.3% for Q3. It looks exactly like it did last quarter before it printed negative. So if they want to say 2 quarters of GDP is not a recession, will 3 quarters make the cut? And I would say the answer is yes. We'll probably get an official declaration sometime in mid-November. And on that basis, what we found throughout history is by the time they declare that a recession already happened in the rearview mirror, the bottom of the market is in. And if you look at institutional managers, they have the highest recession expectations that they've had since April of 2020 and March of 2009. And you remember, in both of those cases, the bottom of the stock market was already in the rearview mirror. And right now we're retesting those June lows. Expectations, if you remember, in June were extremely pessimistic going into earnings season. Estimates are also extremely pessimistic going into earnings season, which starts in a couple of weeks. And I think you're going to see some positive surprise on the earnings upside. I think you're going to see the Fed walk back a little bit of their over-hawkishness. And I think we can probably go into the seasonal strength into year-end with a bid in the market.
Thomas, you know, one of the reasons we love having you on the show is because we want advice from you. So what are you doing in the portfolio? I assume you got plenty of cash laying around. Give me some things that you're buying or maybe you're selling.
Yeah, no, I think what we're trying to do is, you know, we have our core positions. We're not being phased. You know, the thing that people are also underestimating, while the rest of the world is tightening aggressively right now, there's one big pocket of the world that is aggressively easing, and that's been China. And they've been aggressively easing since actually November of last year and March in particular of this year. And the reason it hasn't been felt either in the Chinese economy or globally is because they've had lockdowns and they've had zero COVID policy. You're seeing now Hong Kong is opening up travel. You're seeing less lockdowns in China. And you even saw the most recent industrial production numbers, and retail sales were up 5.4% year on year last month. So as that country's reopening, I think that's going to be some fuel, not only for a boost in China equities, but also a boost in demand globally, despite people being pessimistic. China's kind of been out of the game for the last year, and they're coming back fast and furious. And I think that's going to be a good thing for the global economy. So again, just start the highest quality. You know, we certainly like to start to nibble on the metas of the world. We're going in, you know, we're in a political season. I think people are underestimating the ad spend. They're cutting back on costs. They're going to be cutting back on that metaverse spend, which hurt the earnings. So that's a high cash flow business, a great advertising platform on a global basis. They're figuring out Reels to compete with TikTok. I think Nike was down a lot because of China. I think China's coming back, as we're seeing in the retail sales. And same thing with Disney. It's priced for not positive things on their streaming and in their parks. And I think their park recovery is just getting started. So those are the highest quality. We haven't changed our outlook on Chinese equities. They've been volatile of late, but we think that there's going to be a positive trajectory in the next 3 to 12 months. And we also like the biotech sector, which has been undervalued. It had a monster run off the May lows. It's now consolidating those gains, and we think towards year end it's going to take another leg higher.
All right.
So that's how we're thinking about the markets moving forward.
You are giving us a big homework assignment to do this weekend. Thomas, good to see you. Thank you very much.